Just starting with a sort of very high level view, not just on real estate, but on sort of the wider real assets. And it's fair to say they have done last year what investors expected them to do. So, public markets have corrected quite sharply. Private markets are behind that. So investors at least sort of got that sort of diversification that whatever's happening in private markets happens at a different time. What happens to public market, which gives investors quite a bit of leeway around sort of their allocations. And it also looks like in surveys that investors have not fallen out of love with real estate. So it points all that there's a lot of pausing, a lot of thinking, redoing strategies, but we don't really hear that investors are sort of pulling away from real estate. They're just adjusting their strategies, which is obviously good news for that industry. The big challenge we have is around obviously inflation. And globally, you can see it's shot up everywhere. You see that the average of the last couple of years compared to where we are now. But it's on quite different levels. So in Europe and US, it shot up to very, very high levels. But it's very different in Asia. They are quite digestible numbers still. We would be very happy in Europe if we had inflation of around 2, 3, 4% like they're experiencing in markets there. And that also means interest rates and public markets have adjusted to a different way. So that's sort of the yield shift we see in bond markets, which also reflects financing costs. And you can see especially Europe is hardest hit there, where we're coming from basically zero costs and zero yields to quite substantial ones. In the middle, you can see the US obviously moving in that direction, but not quite as strongly. And compare that to the movements in Asia, which are just a couple of basis points in many cases. So a lot more milder sort of adjustment there to be expected. And that has prompted to investors obviously to pause and invest maybe not as fast and as dynamically as they have done for a while. So these orange curve look like, oh, that's massive fall, but actually it just falls into sort of negative territory that we have less new investments in the next quarter. But if you look at the bar chart there, it's still actually very high numbers in terms of investment volume. So it's nothing like the GFC where the market sort of dried up completely for almost 2 years. So far, it really looks like only a slowdown, and we're almost a year sort of into this. So that's quite good news and quite surprising actually to some extent. We have seen an adjustment in values, and so staying with the theme, different adjustments in interest rates and inflation also led to different adjustments in values, and this is really valuation, so not really spot market prices. So it plays into it how sort of the valuation community in different areas of the world are playing this, and we know the Europeans and the Asian markets tend to be sort of a bit more valuation smoothing going on than, for example, in the UK, and that's why in the UK you see a very strong decline already over the last 12 months, followed by the rest of Europe, and in Asia we're still sort of round about zero or slightly in positive territory. So obviously a much milder adjustment, but also a reflection of sort of the way to do valuations in business in that region. So if you quickly jump through sort of the main 3 markets, the US, Asia Pacific and Europe. And starting with the US, I think the main story there is actually not around the investment market. It is around what is happening on the occupier side and how the different sectors are shaping up here. And the first chart shows the current vacancy rates. So you can see a lot of stress in the office markets, very high vacancy rates, whereas all the other markets actually look pretty good. So the starting point, how these markets are set up in terms of vacant space, is relatively positive for the other 3 sectors. But if you add space under construction, that the picture changes quite markedly. Suddenly, multifamily and industrial, so massive pipelines of new space, especially multifamily but industrial as well. And the office sector actually quite muted. So at least there's vacancy, but there's not a lot of new stock coming online in addition to that. And the retail sector, which has sort of been the problem child of many years now, doesn't add any new space and is already on the vacancy rate sort of relatively low, and there's no space added. So actually, ironically, sort of to some extent, the retail space looks here the best on that chart. And if you look at demand, obviously coming from a time where demand was accelerating and very strong, and it's pulling back everywhere. And it looks quite dramatic, but apart from offices, they're all still in positive territory. So there's still positive demand growth, just not as strong as it was for a while. And it's really only the office sector which is actually really sort of pulling back. So if you put that together, on the one hand, vacancy, the new space under construction, and then in your mind sort of overlay that with what we're seeing on the demand side, it is actually the retail space which looks the best because demand is still slightly positive. There's hardly any vacancies, and there's no, because I mean all these dead malls have been taken out of the market basically, and there's no new space built. The office sector obviously has some stress because there actually demand is pulling back, and we're already having high vacancies. But they want to look out for sort of stress, at least in some markets where a lot of new stock has been built, is probably the apartment sector followed by industrial. So in apartments, that's really the sector where we see a turnaround from very, very positive to actually some markets being potentially quite problematic. And that's the one sort of that you see on top there, places like Austin, Orlando, etc. So moving to Asia Pacific, and that's to some extent the least interesting one because there's actually not that much happening there. So you can see there on the bottom left, you see GDP growth numbers. They're still all positive, not massively big, but positive. And sort of the pull out from that market in terms of currencies, so where investors pulled back from that region. On the right-hand side, you see the currencies have fallen quite a bit, but it actually came back. So it's still quite attractive, especially for US investors to invest there because they get into that market a bit cheaper. But it's no longer sort of that sellout as it was, or it looked like sort of towards the end of last year. And as a result, on the real estate side, there's very little change. So on the right-hand side here, changing in cap rates, you see a slight uptick in some, but it is really on the margin. So the market is more like stagnating or staying still on that level it has reached last year rather than a correction as we see in the US and in Europe. So in Europe, a lot more is happening. And the good news is it is less bad as it was just a short while ago. So the forecasts end of last year, or sort of in late autumn, were extremely negative, expecting a quite deep recession across markets. But you can see forecasts have pulled back from that quite a bit. And sort of a lot of markets in Europe are actually now in positive territory in terms of GDP growth for for this year. So even the sort of harder hit markets like Germany, the forecast is no longer as negative as it was just a short while ago. For the UK, in that it doesn't look yet like an uplift, but if you follow the numbers of the last couple of weeks, I think also the UK forecast will be revised upwards in due course. That leaves us sort of with the main stress still coming from investment markets, coming from interest rates, inflation, and all that jazz. It's sort of causing changes rather than a recession causing massive vacancies and massive upheaval on occupier markets. It's really the investment side we have to focus on in Europe, which is different to the US, where there's a lot more happening on the occupier side. So you've seen here, yields are moving out, and they keep moving out. This is actually sort of monthly data up to sort of a couple of weeks ago. And you can see everywhere it sort of keeps pushing upwards, and it doesn't look like the market is done yet with that correction. And there's good reason to think that it hasn't been done yet, because if you look at how financing rates compare to yields, we're still sort of in non-accretive territory. So if you finance sort of core assets in Europe currently, you still can't use financing because the financing costs would be higher than your running yield. And that sort of does suggest there is more adjustment to be needed to at least get in positive territory there. I wouldn't expect that it moves massively in positive territory, because obviously we had a long period of time where financial engineering was really helpful to real estate returns. Financing was so cheap that even on low yields it was easy to deliver quite strong returns. So I expect that we will be able to finance again, but it won't make that big contribution to returns as it has done over the last 5 or even 10 years. Hence, our forecast is that there will be more value corrections to come, and taken to the ones we already have seen, together with what we think there is still to come this year, you get to these numbers you see there on the left, which is sort of a value decline from the very peak end of 2021 to the bottom sometime this year. And you see it's around -10 to -20%. So it's significant, but it's nothing like what we have seen in the GFC. And what also is quite striking is that it is quite uniform. So the difference between the sectors is not that big, because it's not driven by vacancies or problems in different areas or in different cities or countries. It is really driven by the financing costs, which hit everyone the same way. So that's why on the right-hand side you see, just taking the logistics sector as an example, where the declines were very different depending where you were in Europe after GFC, whereas now it is relatively similar. That also, I think, means sort of that big divergence between sectors we've seen in Europe over the last 5-10 years is probably over, because the retail sector has adjusted to that low growth environment. It offers high yields but no growth. And on the other hand, we have multifamily or logistics or something like that, which offers a lower yield but obviously a bit more growth potential. So in the end of the day, probably a total return from now on is probably not too different in these different sectors, whereas in the past couple of years it was very, very different. Talked about in the US that we have sort of a lot of upheaval coming on the occupier side. In Europe, we still think the occupier side is actually going to be helpful to overall returns. So we think it's going to dampen the overall decline in values. So what you saw before was taking change in rents and changing in cap rates together. If you separate the two things out, you see if you would not have any rent growth, for example, in logistics and offices, you would get more value decline. And obviously in sectors like logistics, that's more important because growth is higher. But even the office sector, which is probably also the one facing the most challenges in Europe, not as much as in the US, but there's certainly some challenges there. Even there, sort of the contribution from rents is marginally positive and doesn't add to the decline, in our view. So if you look beyond that, say, probably most people agree there's some sort of bottoming out in the market at some point this year, maybe later this year, maybe early in 2024. But what happens next after that? And our view is that sort of the neutral interest rate in Europe remains very, very low. So it's just above 1% according to the ECB. So we think at some point the ECB will be forced again to push markets forwards and offer a relatively low interest rate as soon as they can sort of get to grips with inflation. This is just one forecast. It might happen very gradually, but it might take obviously quite a bit longer than that. So you don't want to forecast that path exactly. But I think if we do investments today, we can be relatively confident that attractive pricing we achieve at some point this year there will be a more attractive exit yield at some point, maybe in 24, maybe quite a bit later. So don't pin me down on that, but I think that's sort of the trajectory where it's going, where we're ending up is more positive than a lot of people think currently. So just to finish up, because sort of the pain on the direct side is what makes people on real estate lending, which Nuveen is also doing, is making very happy. So these graphs pointing upwards a lot higher. Interest rates can be charged. This for debt funds, obviously, a very attractive new proposition. And so the same chart, which for us is costs, is for that side is return, and it's looking really good for them across the board. And as lenders are being quite sort of active in that sector, especially if they're sort of not banks and not constrained by anything like that, and are quite keen to lend. The problem is rather that a lot of propositions, you get in trouble with your ICR covenants because on the yields we currently have, the interest rates being very high, a lot of properties can't really fully finance sort of their interest rate costs. So it would be very attractive for us, but often we can't do it because it's too risky because there's not enough rent coming in. On the other hand, if you take sort of all these changes going forwards, if you calculate how much extra margin you need from different markets, it usually comes out as quite moderate. So 20, 30, 40 basis points in most European markets. I mean, there's very volatile ones in other parts of the world. But in Europe, to compensate a lender for sort of the more risky environment they find themselves in, we don't think there's so much more margin adjustment needed, and it can be quite attractive relatively quickly. And it also doesn't look like we're going to get a lot of delinquencies, of what was typical after recessions in the past. I mean, this is US data, but currently there's no real sign that we're going to see enormous amount of trouble. I mean, it's going to get worse than the current number, but I don't think we're going to see anything like we have seen in the really tough years, 2009 and afterwards. And that's why origination stays quite strong. There's a lot of refinancing needs. As I said, investment volumes have come down, but they're still historically quite high. So there's a lot of opportunity, obviously, for real estate lenders to be in a market, and they're taking that opportunity as good as they can. That was a very quick run through. I hope that gives some food for thought and discussion.
Great, thanks, Stefan. Really interesting panel. So we have Assem, obviously from Berlin HIP, who's representing the financing side. We've got Audrey Klein, who's a non-exec director at SFO Capital Partners, but also Planet Smart City and various other hats. So lots of things from them. We have Megan as well from Allianz Real Estate, and Stefan, who you've already met. Just do a very brief intro, 1 minute each, just on, I mean, I've given a very brief summary, but just of who you are and what you do. Let's start with you. What does that day job mean, Assem?
Okay, my name is Assem Alami. I'm heading the origination for Berlin HIP. Berlin HIP is a real estate lender, senior lending, and we're part of LBBW Group. Combined LBBW and ourselves, we're the biggest real estate lender in Germany, with a loan book of approximately 54 billion euros or so. We're active in France, Benelux, Poland, and the Czech Republic, and Germany, of course. And, well, I guess that's the minute, isn't it?
Great. Megan.
Hi, I'm Megan Walters. I head research for Allianz Real Estate, which is the captive under the Allianz Insurance Group based in Germany. And by background, I'm a British trained chartered surveyor. I've actually spent most of my career in Asia, both in Hong Kong and Singapore, most recently with Jones Lang LaSalle in Singapore. In terms of the Allianz portfolio, we have about 90 billion of euros under management, about half of that in office, about 70% in Europe and about 15% in the US and Asia Pacific respectively.
Great. Audrey.
Audrey Klein. I've been in the real estate industry for 20 years. 10 of those years were with Blackstone. I now sit on a couple of boards, as Richard said. One of them is an affordable housing firm that operates in emerging markets. The other one is an asset manager based here in London that focuses on industrial and multifamily. I'm the ESG chair for both. A couple of years ago, I saw this great trend in ESG, and I went to Cambridge and got certified in ESG. So that's how far kind of the ESG or Cambridge is capitalizing on ESG. And I'm about to join a partnership at the end of March with an established M&A firm and help them grow their fundraising business.
Great, and that's the first time that's been announced, Audrey, isn't
Yes.
it? Okay, interesting. Good. Stefan, you very kindly didn't say much about Nuveen, so now's your chance.
Okay, I look after research for Nuveen in Europe. There's similar teams in Asia and in North America. Nuveen is owned by TIA. TIA is sort of the teachers and professors pension fund in the US. We invest their money globally, but as well as sort of third-party capital from around the globe in sort of the big three regions. And we are part of sort of a bigger business in real assets. So there's many colleagues who do infrastructure, farmland, renewable energy, and things like that. And that's sort of a bigger business now here in London for Europe. And I mean, just on the ESG front, actually my team is part of what we call the Strategic Insights team. So our colleagues from the sustainability and technology side are combining that because we're recognizing sort of looking into the future, the ESG angle is very, very important. And that's why we sort of sitting together and working together as a team.
Great, and that's for sure one of the trends we're going to pick up. One of the other things that Audrey didn't mention is that she also sits on the board of Great Ormond Street Hospital and had a big role there in bringing some of the real estate investors that you will all know also into supporting particularly the Sight and Sound, new Sight and Sound Centre that opened the other day, and I saw it is amazing. So if anybody is interested in that area, do contact Audrey afterwards, because it's one of the projects that we also helped kind of highlight and support, and there's more things coming which can be mentioned later, I think, not during this, but there will be more news on that shortly. Good. Let's dig in a little bit. So Megan, just in terms of some of the key trends, we had some of them highlighted there by Stefan, but from your perspective, what are the key trends that you're looking towards for 2023, for this year? And I suppose, do you broadly agree with Stefan's analysis? What's your view on it?
Thank you. Well, thanks for having me here today. And yes, I do broadly agree with Stefan's analysis, so it's nice to be joined together in this. Look, for us, the global outlook is for a modest or mild recession. So our in-house economists at Allianz have put this out in the public domain. So modest to mild recession. I was at the RICS valuation conference on Tuesday this week, where we had Rob Elder from the Bank of England with his sort of Bank of England forecast as well, again for a sort of a modest or mild recession. And you can see that in Stefan's data around things like US demand being relatively robust on the real estate side. So the problems that we might feel coming towards us are coming sort of broadly from three main areas. We were always going to have supply and demand disruption post-COVID. So we were always going to have spikes in inflation in different areas. Now we have China opening up, finishing their COVID policy. So again, we'll see pockets of supply coming forward from China, but also pockets of demand coming from China. So again, more disruption on the supply and demand post-COVID, driving inflation. Secondly, we are practically a year to the day of Russia's invasion of Ukraine, driving energy prices in different directions. So again, issues coming out of inflation with energy pricing. Now, it's been great for Europe that we are through the winter and gas storage in Europe is still about 70%, which has been phenomenal. But this could go on another couple of years. I mean, who knows what Putin does and how long this goes forward. So still continuing problems there. And then the third part is the labour markets, which have changed significantly post-COVID. Some people have left the workforce. Some people have decided to take a more of a work-life balance and perhaps work less. And so we've got a shift around in labour force, I think really globally. So you can see in many markets, vacancies outnumber number of jobs. In the US, these are sort of some statistics that you can see. So we've got sort of relatively robust labour markets. So that's going to drive wage growth, which is going to feed into inflation. So in fact, you've got kind of like three different areas that are going to feed into inflation. And then that makes a problem for central banks. I agree with Stefan's analysis about where we might end up on interest rates. So the fact that the ECB towards the end of this year will probably have to sort of find that they've reached the limit of where they might go with rate rises. And so that will provide additional sort of visibility into real estate markets. So I'll just finish with one line on real estate markets, which is if we think of the occupier side, pretty robust. We've had rent growth in sort of European offices. Average rent growth was about 7% in Europe for office, sort of relative strong demand. And then it's on the investor side, well, we're waiting for the pricing and the maths to catch up because of the interest rate movements.
Okay, good. And Audrey, I know you were at the AFIRE conference last week in Washington. So I suppose any views that you've got on that, but also what was the sense there in terms of the sort of global trends that they were looking at?
I was really surprised. Normally, when you go to a U.S. conference, the thing that sets it apart is that everybody's optimistic about everything, including the food. There's real doom and gloom, and people really kind of, thinking that by the end of the year things would be better, but there was going to be a big kind of correction between now and then in all asset classes.
So very different view to some of the ones that we've had, for example. That's interesting. And Assem, what's your take on some of these kind of key trends? I suppose we'll drill down in them to the later, but what's your sort of sense of the main things that you're looking at from your perspective there?
Well, I think the key for us is the chart that you showed with the interest rates peaking at the end of the year, and then we'll have a slow decline in interest rates. I think that will influence many of the things you just said. I could not disagree with anything you said, but it all depends on how, if we slide just over the recession, we don't go into a deep recession, if it's long or short, whatever it is. And my worries come a little bit from the American side when I see that private debt is growing again, and that there are some questions about how robust those credit cards will be, et cetera, or car financing and other. So that's where I sort of am reminded of what happened just before the great financial crisis, and what were the signs that we were picking up, right? And the signs came from the U.S. So that's just something which I don't have any reasonable view to do. Oh, this was going to be terrible, but that is I'm looking at that, I'm getting a bit uneasy when I hear news from the US in that sort. So for us, it's 2023 will be a year where we'll be cautious. We'll be in the market. We'll be doing business, and we'll be doing very happily. We'll do business, but it's It's a year where we expect price corrections, and I think we're going to come to that also. Price correction in different sectors. In some sectors, price corrections have already been pushed through. In some sectors, we still expect quite severe corrections. And where the debt level will not be, in particular when it comes to refinancing, where the debt level we can propose on the new values will not be the same as the debt value that we had beforehand. So there's going to be, for us, in our business, there's going to be less investment loans and new lending rather than more refinancing of existing loans, and to see okay how the decrease of loans of values, excuse me, can be transformed in a sustainable lending structure.
Okay, good. I'm going to pick that up. We'll drill down a bit more into the financing side, because I think that's interesting, and especially picking up Stefan's point there as well, that maybe some of the funds will then seek to increase what they're doing and pick up some of that. And I wasn't going to touch the sectors until in about 10 minutes, but because we've got Sally here, and Sally is a researcher in logistics, I thought we might just get a 5-minute view from you, Sally, and I know you've got to go at 9:30, so I'm gonna pass this over to you, and I'm going to say, what's the view on logistics?
I was expecting a question, Richard. I wasn't expecting to join impromptu panel. Well, thank you, and it's interesting to hear everybody's comments around logistics. And we were talking earlier, Assem, about the logistics market. I mean, broadly speaking, it's in terms of investment pricing, it's corrected hard and fast, very fast. In some cases, the UK in particular, but we're unique here. You know, we have our political instability and everything. But we've seen a correction across major markets of between 90 to 100 basis points for prime over the course of just 9 months, or since the peak in pricing in Q1 for most markets. In terms of where it's going, we anticipate that there will probably be some more movement this year. Activity is challenging at the moment. There is little. There is two camps in the investor side. There's a wait for correction to continue, but there are others who are seeing value and are starting to become starting to deploy capital. There is still an awful lot of conviction in the sector and understanding the fundamentals, but we're now seeing far more due diligence around understanding assets, specific assets in specific markets, whereas perhaps in the previous few years there's been a lot more drive to rebalance portfolios and deploy capital into investment, which of course drive values. The key, I think, which is fair to say for all sectors, but acutely particularly when we're thinking about the pricing correction, is understanding the occupational side. And I've been saying for some time, when particularly being asked questions, is there anything we have to worry about in industrial and logistics over the last few years? The answer always has to be understand the value of the asset to the occupier, and that's even more acutely important in the context of occupational demand slowing, which we are starting to see, having reached a peak in mid-2022, where we saw the market peak in terms of occupational take-up at around 45 million square metres. We've started to see that falling back over the past 2 quarters. We are anticipating that is, well, we know that this is down to not necessarily a lack of occupational interest in taking new space, particularly where it becomes operationally and cost efficient for them to take new space rather than labouring with older buildings. But it is the lengthening of their decision-making process. And across our network of brokers across Europe, and indeed globally, we're seeing this in the US as well, we are seeing the decision-making process within occupier businesses slowing down. And, as they take a view about, is this the right deal, the right time, the right location, the right building? So, but we are still seeing plenty of inquiry. So we are expecting that demand will continue. It's just slowing down the process. So I would say and again, we're also anticipating that because that demand pressure is there, and with other things supporting the costs of building, and with availability remaining constrained in most markets, we are expecting rental growth to continue. but at a milder rate than perhaps we've seen in some geographies where we've seen extraordinary levels of growth over the past several years. We are also suggesting that rental growth will become more patchy. So it will become down to understanding localised markets and what the supply-demand dynamics are, whereas over the past few years it has been all boats rising in the same tide because the pressure has been universal across, but now we are expecting to see it far more localised, and so therefore understanding the market fundamentals for the asset that you're particularly considering will become even more acute. So due diligence is the most important thing.
Interesting to get your perspectives on that particularly. Let's drill down a little bit into the sectors. So maybe Megan, just with you, and then I want to pick up on ESG especially. But in terms of the sectors, what's your view? I mean, pick up the view on logistics there, if you like, but also office particularly. What's your view on those kind of main sectors?
Well, thanks, Sally, for the comments around logistics. They're really helpful. So I think we'll part logistics there, and I'll talk about office markets. So we are one of the world's largest investors into office markets. So at the start of the pandemic, I recently just left Jones Lang LaSalle and joined Allianz. And a few weeks later, there's COVID working from home. And the question is 225 office assets in 47 cities. Which ones are going to be most affected by working from home? So there's a project to get started on. The way we analysed it, we spent obviously a lot of time thinking about it and talking to different researchers. We came down to density. So what works is looking at density of cities, because in high density cities, in the heart of city centres, office space tends to be more expensive, so it's already been rationalised in terms of not much spare space can be given back. People are already fairly well packed in. In high density cities, apartments tend to be smaller and more expensive, so people tend to want to go back to the office. And again, in high density cities, you tend to have better public transport. The maths of public transport works better. So again, people are more likely to go to the office. So we were fairly quick to identify that the Asian cities would be fine. And that's pretty much turned out to be true. People are back in the office in Asian cities. So Tokyo, Shanghai, Beijing, Singapore, Hong Kong, people generally go to the office because they've got small apartments and good public transport. European cities, again, people are back in the office in the heart of European cities. So the highest density cities in Europe are actually London and Paris. And so if you look at, say, vacancy rates, but it depends where you want to go. So just to pause on London for a minute, West End vacancy 4 to 6%, City of London vacancy 8 to 8%-ish, Canary Wharf vacancy 15 to 17%. So what you can see out of that is people want to go to offices where you can go to work for other reasons, like bars, clubs, restaurants, going to see your friends after work. So other European cities doing relatively well, Munich, Milan, Madrid, everybody back in the hearts of those cities. So the density maths worked great for Asia, worked really quite well for Europe. The US. So US vacancy rate, I think you had it at 12%. We've got it, I think we're using some JLL data at like 19% vacancy in US office markets. Whereas Europe, vacancy rate average is about 7%. And in the heart of cities and the super prime assets, it's more like 2% or 1%. You can't get the stock. And everybody wants that type of ESG stock, which we'll come to. US markets, much more difficult. I firmly believe people will end up back in city centres. At the moment, suburban office is doing better than CBD office. But I'm a firm believer that ultimately youngsters will refill New York, that people will go back to Manhattan. There's always an evolution in cities. I appreciate we have tech layoffs. I appreciate that, things are not looking great. But fundamentally, I think people will end up back in these cities in the US.
What's really interesting is so last week at the AFIRE conference they had a mapping per state.
Yes.
And it varied greatly per city.
So
per state.
So people back in the office in Austin, Dallas, Phoenix. So those Sunbelt cities, about 3 million people moved out of places like LA and New York and Miami, and then moved down to the Sunbelt cities of Austin, Dallas, Phoenix. And so I think, and because you can see it in the open table restaurant reservations, they're still above pre-pandemic levels in those cities. Right. So that's an indication that people are kind of, this is the sort of data we were using. So that, that's an indication that people are sort of back in the office in those locations. But sprawl LA is a good example of just sprawl. It's got the same density. So we measured all the city densities at the 20-kilometre area. LA's got the same density as places like Madrid, Milan, which is about 4,000 people per square kilometre. But when you draw a map 20 kilometres out of Madrid and Milan, you're into countryside. So your 20-kilometre has drawn in everybody. 20 kilometres in LA, you've still got sprawl. I mean, it just goes for miles. So, yeah, so geography and mapping is like to Sally's point about you get really locationally specific to an asset as to whether it works or not. So for us, mapping and geography, and back to kind of like old-fashioned real estate, as opposed to just worrying about the capital stack, became really relevant for us. So we're good on office markets for the right asset in the right location.
But does that mean that the young generation, which will come back massively into the office, is going to make us forget COVID, and it's going to be on pre-COVID levels?
Well, I think there'll be a slowing in the rate of absorption. So I think we'll see less new construction. Mm-hmm. So I think the office stock we've got now, and there's a couple of reasons for this. One is cities, I think, are going to slow down demolitions because of embedded carbon. So cities themselves have got ESG things. So I think we build fewer offices going forward. Mm-hmm. So I think we've still got youngsters migrating to talent pool cities like Berlin, like Amsterdam, like Barcelona. And on the other side, we've got far less new construction. Mm-hmm. We might have a lot of ESG refurb. Do you want to go on that?
Well, not quite. It also, from the mapping that I saw last week, it also varied greatly sector to sector.
Okay.
So the financial sector, people are back in the office. In general, like more than tech.
Oh, yeah.
Actually, so tech, there's like a revolution.
Yes.
So that's where the biggest problem is actually. Although they're saying that as all the layoffs are taking place, you'll see these people running back to the office because they want a job. Mm. So it's a very kind of muddy area.
Mm. And do we think the acronym Tuesdays, Wednesdays, and Thursdays for people who don't work or work from home on Monday and Fridays? Do you think office is just going to get used to that fact? Like nobody used to worry that people didn't come into the office on a Saturday and Sunday. But you still had to have an office that was capable of holding all of your workers and guests. Do you think that will still be the case, and people will just go, yeah, okay, well, there's less density on a Monday and Friday, and we now expect that?
Well, I always think there was. I mean, if you look at the metrics of office usage on a Friday, it was only. I mean, offices generally were only ever occupied to 50%. By the time people are on annual leave, by the time they're off on sales courses or training courses, office utilisation was never particularly high. We just never bothered to worry about it. And now we've started to think about it a bit more. I think that office, as I say, I think we've got the stock we've got. We may not necessarily add a huge amount to it. Maybe it just becomes more mixed use. It certainly becomes more fun. Mm-hmm. We perhaps get end of journey facilities, like we get better showers in offices. So if we didn't want to cycle to work, we could do that. We certainly get more meeting rooms. We get hopefully some more bars and cafes, more mixed use coming into office.
Well, I'll tell you something interesting. I went down to visit one of the Mindspace buildings yesterday. Does everyone know what Mindspace is? It's kind of like a WeWork. I was really surprised to see the types of companies in Mindspace. I thought it would be all kind of, startups and
tech
youngsters. And it's not. It was a real combination of, names, regular way names that, established companies mixed in with tech companies. So, so I thought that was really indicative of what's going on.
Approximately half of the members, as they call them, at WeWork are big corporates. Actually.
Yeah, exactly.
And do you think there's going to be, if people did move slightly out of London or move out to different areas, do you think there's going to be more of that sort of, shared co-working space outside of cities, let's say in the periphery of London or in smaller cities?
Well, I also know of a really good regional office fund manager, and they're doing really well. So I think it's really helping the regional office spaces.
Well, I think that's an interesting one, because in some way the footprint of a large city gets bigger, because if you only have to come to the office a couple of days a week, you could live a long way out of London and come in. So in that sense, the footprint of London could get bigger. Mm-hmm. I think the one thing, I don't know, is Stockley Park still a thing in the UK? None of us are from the UK particularly. Is Stockley Park still a thing? Yeah, so it's just like, without sounding kind to whoever owns Stockley Park, who would want it? I mean, why would you have an out-of-town place that you positively have to get in the car and drive to? Because from a tenant's ESG, net carbon zero ambition, why would you have an office space that isn't by public transport? So, given that most large occupiers themselves have net carbon ambitions, I think we will continue to see offices in the heart of city centres, if only from a public transport and, as I say, bars and clubs, restaurants, reason to go to work. That's why I go to work.
Can you just ask a question? So would it be, which I would agree, would it be fair to say that we're actually have a polarization of the office market, being that the downtown centre locations, due to increased mobilities and also the fact that we accept that an employee could be in the office only 3 days a week, that those offices will encounter an increase in demand, but the peripheral offices, I don't know Stockley Park, but anyway, the B, C locations will suffer quite severely under that pressure, wouldn't it?
I think we can see that in the data. I mean, Stefan, if we look at sort of like the CBRE, Class A, Class B, vacancy rate and rent data, you can see the divergence.
It's all coming together. Out of town, you have the ESG issue, you have the issue that it's not particularly attractive to go there, you need a car, and it's all conspiring against Class B, not that value located places. Mm-hmm. And it's consolidating in the good location, the good assets.
So I'm building the bridge now for you. So does that mean that the ESG, the negative discount on values is not big enough? The assets are still too expensive, the non-ESG compliant.
But funny enough, if you look at sort of what actually is happening on deals, you see a lot of, ESG challenged buildings which used to get like 10, 15 bidders suddenly just get 5. They still get sold. So there's still people out there who seem to not believe that's an issue, but it's getting fewer and fewer. And it's only at the point where there's no bidder, or only 1 or 2, when it actually gets reflected really in the price. So I think there's a tipping point coming up pretty soon. And in some buildings, Asians already say, well, it's pretty hard to shift because there is a massive, energy bill or something attached to it, which is very difficult to change. And we have in that issue, like at research, we constantly get the question, where's the brown discount and green premium? And I keep saying, like, it's very hard to measure. And it's also, if you can measure it, what does it tell you? It just tells you the premium from yesterday. But the problem is what's going to be in 1, 2, 3 years when you want to sell, and what's the premium going to be there? And you can't deduct it from what happened last year. So you have to make a leap of faith. Where is that market moving? And do you believe, net zero carbon and all that, the CREM path is going to be embedded in things? And if you believe that, then you have to act now and still find someone who is not well informed enough and takes it off your hands for a good price.
Okay. Well, I can say that lenders will increasingly look at that ESG risk, and at one point those assets will not be lendable. I don't know if that word exists.
I think that's it. It's a hard stop.
Yeah.
It's not like this is a slow decline down in terms of value. It's a hard stop because one day no one's going to lend on the asset.
Exactly.
And that's it. And then it's, I'm going to say it's worthless, but it's...
No one wants to occupy it, no one wants to buy it, so you
can't lend it.
Yeah. That's, I guess, stranded, eh?
Stranded.
And then what happens? Then is there transformation finance going to be available? Who's going to come in and do those transformations? Is that going to be specialists? Is it going to be, that you would develop teams at Allianz or at Nuveen to actually look at those assets that you've got in your portfolio and actively transform those? What's the plan?
So, well, I'm going to talk for Allianz, which is we have very, very good asset management teams working through all of the office portfolio. And so most of ours, as it turns out, are in the heart of these high-density cities. Having gone to the effort of mapping everything, there were a few. It's like, oh, what's that funny one stuck out there? And then people would say, oh, that's an Allianz own use insurance, I don't know, but sort of secondary office area. So we did have some own use, but the prime investment portfolio actually for us, I think it's because we're core investors, does tend to be in the heart of the cities and really kind of in core areas. But yeah, I think there will be a role for value add funds to look at secondary locations. I mean, I think once an asset is in a secondary location, you're more likely to convert the use. So I think the city governments have a role to think about converting the use or making it easier to get use conversion. Again, I understand that the physical fabric might not work, but at least the plot could be rezoned for residential, given that we have a massive shortage of residential in most major cities.
Mm-hmm.
Well, you already have regs coming down. You know, these aren't like pie in the sky ideas. They're actually on the table, SFDR and European taxonomy, that are forcing the issue. You know, I mean, if you're a large real estate firm and you don't have an ESG strategy and a plan in place and at least UNPRI and working towards a GRESB rating, you're living under a rock. You know, and I would hope that everyone here is with a firm that has some kind of ESG plan and strategy, or you're going to be a sad person in a few years.
I won't do a show. I won't do a show of hands.
So, to some extent, it reminds me of the discussion we had like 10 years ago on retail, because it was the same, like, oh, there's more online shopping, but is it going to really affect shopping? So the people want to go shopping, and it was always found an excuse why it's going to be all right, and it was all right until it wasn't. And here it's the same sort of thing. It gradually comes, and at some point you see it in the numbers. But once you see the numbers, it's too late to actually take action and protect your values.
And beyond SFDR and European taxonomy, you're going to there are cities that are thinking about putting into place legislation like New York did. You know, they put into place New York Common Law 97. I'm not sure why it's 97 because it wasn't in 1997. But they basically, like, if the penalties start in 2025, okay, which is just around the corner. If you're a 20,000 foot or above building, you're going to get penalized if you haven't met certain standards. And it's even worse the longer it goes on. You know, 2030, there's another set of penalties, 2035, et cetera. You know, Boston has just put a similar law in place.
The Netherlands have a similar strategy. I think it's from this year on that no office building can be used as an office building if it has a D or worse energy rating. And I guess that's where a lot of people, even in the Netherlands, still say, okay, the problem is so broad that they cannot. The legislator cannot just leave it like that. There will be some solution. And I sense there's a lot of this speculation on the softening of the legislation or of the regulator in different countries. And in Germany, I talked to several residential owners who said, okay, well, it just can't crystallize that way as it is regulated, because then the whole industry will be, I exaggerate, would be broke. But I think a lot of people are underestimating, a lot of the people I talk to are underestimating under which pressure we are with taxonomy, et cetera.
Does everyone understand why, all of this is happening? There are other asset classes that have ESG plans in place, but the focus is really on real estate because real estate is responsible for 40% of carbon emissions. So, I mean, that's a pretty big chunk of total carbon emissions.
Yeah,
so that's
exactly, and that's why I think the speculation on regulators softening while they're going is not a good strategy. But it's are there a lot of people living under the stone? I don't know. It's more, when I talk to people, it's more about, okay, I see the necessity, but how am I going to make that work out?
Sure. Well, okay. So just a practical piece of advice. There are a couple of really great consultants out there that basically, I mean, you've got to get in line at this point, because they have more work than they can handle. There's one that I think stands above the rest called Evora. Okay, it's a guy run and founded by a guy named Paul Sutcliffe, who's with DTZ, running sustainability 12 years ago. And anyway, timing was pretty good for him because he now has offices all over the world, and he's submitted more successful GRESB applications than anybody else. I think something like 200.
Wow.
So GRESB is like the high. Again, I don't want to assume that everybody knows what GRESB is. GRESB is the highest standard you can achieve right now.
And coming back to funding transformation, yes, Berlin HIP, we've been on the ESG path ever since 2015. So we've been emitting ESG compliant covered bonds ever since then, and in different classes, we even issued our first social bond. That's exciting. But we're also offering to our clients the possibility to get a so-called transformation loan, which means they get a benefit when they transform their building into a ESG compliant product, which means on the other hand that they have a plan and they have a path in which they will get there. If we, as a lender, take a brown building and we don't have any perspective of this turning into a green building or a near green, light green building, let's put it this way, then we're probably not going to touch it, or on a very, very conservative basis, but most likely not at all.
Yeah.
Yeah.
I think a big part of the problem about it not moving fast is around valuations, because you can't be the only one who puts that into your valuation, because otherwise you look like you're underperforming. So you can't be the first one to sort of allow your valuers to fully reflect it. So everyone sits on the fence and says, well, you do it, then I do it. And then that is sort of holding us back. And if you are the only one who does it, you look like in all the performance charts as the one who's just underperformed because he lost 5% of your value or something.
Let me ask you, how much, I don't know if you can say that, but how much of the cash flow, the available cash flow of your portfolio is being put away for ESG related capex?
I really don't know the numbers, but it is in our heads, in our internal business plans, but we can't really put it in the valuation because that would be self-defeating in terms of the business. That is the issue. Yeah. And no one else does it, so basically everyone has to move together, and it's going to happen at some point. The values have to force it. They say there's evidence that buildings which have a gas boiler, whatever, fetch that amount less money, and so now I have to revalue a building because it has a gas boiler. And that point is going to come. It's just not there yet, unfortunately.
But that's a way of hiding behind your small finger, right?
Yes, yeah.
There's technology that's being developed on a regular basis. There's a lot of innovation happening around this topic. For example, there's everybody talks about prop tech and never gives examples, so I thought I'd bring one along. There's a piece of software called One-Click, which is transforming construction and BIM and so forth, and it basically allows heads of construction to design and see what their carbon emission will be real time. So it's pretty amazing. Has anyone used One-Click here? Anyone? It's a pretty interesting piece of software. So
I think the biggest issue is relatively new buildings. Because if you buy a 20-year-old building, you expect that you have to invest a lot to make it shiny again, and including that, you putting all the ESG measures in to make it, not stranding. But if you buy a 3-year-old building, that boiler actually has a lifetime of another 20 years. If you have to change that well before that, that's a massive cost. So these are actually the riskiest buildings, the relatively new buildings which haven't got up to a good standard yet.
So it'd be interesting just to get a sense of where we think the capital is moving, what the capital is looking at, both in terms of sectors, but also let's focus on Europe for now as well, in terms of whether there's cities, countries that people are looking at. Maybe start with you, Megan, on that one.
Sure. So happily, the ANREV, INREV, NAPREF Investor Intentions Survey comes out in January, which we love. They normally interview a couple of hundred investors. I think the total AUM is about $1 trillion in terms of the scope of the survey. You had one of their charts on your first slide, which was what are they looking at in terms of real estate? So number one is normally diversification. It still is, but coming fast up the line, which was at the bottom, the line spiking up, was inflation hedging. So even with the kind of hold up in the market that we saw with transaction volumes kind of drying up at the moment, people are still very actively looking at real estate because of a hedge against inflation. And as we discussed, we don't know how long these interest rate higher for longer and inflation might be with us. So investors still definitely looking at real estate. In terms of the investors themselves, Asian investors under-allocated to real estate, and in fact US investors saying that they still want to allocate more to real estate, which I think is interesting. Europe, I think the number was because of the denominator effect, because of the equity and bond market sections of their portfolios have fallen. They might be on a pause in terms of new money to real estate at the moment. So that's kind of on the investor side. So Asia and US investors looking at Europe actually want value add. So they're prepared to go up the risk curve. I think once they've come overseas, they're prepared to look at value add here in Europe. Europe investors tend to prefer core for the moment.
Okay, interesting. And does that match your kind of sense as well, Stefan?
Yeah, we would have said something very similar. So not much to add. Maybe just one point on sectors. I think the sector allocation hasn't changed very much. So people still love logistics and love multifamily and are very hesitant about retail, slightly hesitant about offices. And that was the case before the interest rate change, because fundamentally, we're still looking at the same fundamentals as a year ago. We just look at a different price level. So maybe that's something where we don't see much change.
But what was interesting is that on the sort of the occupier side of real estate, it's still okay. People are still out there paying rents. People are still leasing buildings. Obviously, with the recession, Sally from Logistics making a very good point about occupiers slowing their rate of decision making, but people are still out there, functioning in the economy, hence a mild recession. People are still out there. It really is. It's on the investor side at the moment that we're having a bit of a pause. So what investors are going to look for is areas where there is growth, where there's population growth. So the cities growing fastest. Berlin always comes up well as a city growing fast. Barcelona, Amsterdam. I think anywhere where you get these concentrations of we're going to call them talent pool cities. So whether that's tech people or life sciences people, because that's all coalescing together. If you're a tech person, you can be in dry labs doing life sciences. So those sorts of industries people are still thinking about.
And very typically, people not picking up on sort of where the greatest value might be had. So after GFC, no one wanted Italy or Ireland or Spain or anything like that. And now the same would be for Eastern Europe, when it's not up people's wish list, even if, potentially there are very high returns to be made, but it's a high-risk play, and that's not for European investors. We probably have the Americans at some point picking that up, being much more adventurous on risk.
And Assem, does that kind of, I suppose, is that what you're seeing in terms of the types of investors who are coming to you looking for the financing side? Are you seeing people looking for value add? I suppose what's your sense of that? But also, how do you see broadly those sectors? Has your view changed on any of those sectors, or like Stefan, is it broadly the same, but it's just at a different price point? What's your sense of that?
Yeah, I would. When it comes to the sectors, I would agree with what you've said. We're still enthusiastic about offices and within the limits that we just lined out. Of course, we still like logistics. Good that there was a correction, because the yields were, in my sense, just too low and beyond reason sometimes, I would think. And retail still in some kind of limbo, and we do finance a lot of multifamily homes, which is still very solid. In terms of what kind of risk we're looking at, well, again, I think it all runs down to what has always been important in any kind of downturn is where's value creation, and value creation is today ESG is a very good way of creating value and protecting your capital value. So whatever our client says about ESG is also decisive on how we view that particular project.
And does this also mean, it's a general question for anybody, does this also mean that, those sectors that are more focused on ESG, and I'm thinking about the social impact side as well there. So, life sciences, for example, healthcare, affordable housing, senior living, student housing, those kinds of sectors which naturally fit into that ESG responsible investment side are going to do better than others?
Well, I mean, life sciences is doing well just on its own, without, touching the impact angle. I don't know if anyone saw the two articles that came out a couple of months ago, one from the FT and one from The Economist, on how, life sciences could be the beacon of light for the UK, in getting us, kind of out of this GDP slump. I mean, the innovation that's going on in life sciences in the UK is just coming mostly out of Oxford and Cambridge is amazing. However, one of the articles did say that the building of space is not happening quickly enough, and a lot of companies are going to Boston. So there's a real run here in the UK in the life science space, and there's a lot of money flowing into that space in order to make up the difference.
Yeah, we've done before some focus as well on what's happening in Scotland there as well. There's a lot happening, with Edinburgh Biotech and various other things going on there. So there's definitely an investment side. Courtney, it'd be interesting just to get your view briefly on. So this is Courtney Finger. If anybody doesn't know Courtney, it would be good to get your sense just on that sort of FDI angle for some of those maybe, but also the FDI angle in terms of the real asset side.
Thank you, Richard. So yes, I'm the FDI lady. So I say there's sort of the real FDI and real assets, and then there's a space in between where they meet. What I think is it's really interesting to hear your take. By the way, Megan, I think we were on a panel at MIFM last year. So it's good to have your take. And where real FDI and real assets meet is largely around the cities and the locations and all these things that you're speaking about. And what we saw in the FDI market last year is there was a really strong post-COVID rebound with global FDI flows rebounding really, really nicely. But then the recovery is under threat now from geopolitical instability, supply chain dramas, and so on. So we're watching to see. The main thing about FDI is that it's a long horizon. So companies they're having to make long-term decisions about where they put physical facilities without really knowing what the lay of the land will be 5 years in the future, so it's really difficult. But there's a crossover with the trends you're talking about. Life sciences is a very healthy, booming FDI sector, for example. So life sciences companies really active in cross-border expansion, and a lot of biotech hubs around the world competing strongly for this investment. And also around logistics, we heard about, because of all the supply chain volatility, a lot of locations trying to position themselves as the new logistics hubs and distribution centers. So that's driving some of this activity that we're seeing in the logistics sector. And I guess the third trend is, of course, around the ESG. We spoke about it at a breakfast briefing just last week, where the inward investment agencies, those government entities that are charged with attracting inward FDI and doing the economic development strategies for their locations, are now having to be more careful and not just taking any old investment from any old company, and think really carefully about who they want. And of course, this gets down to these would be the corporate occupiers, essentially. So who's coming into these facilities? Who are they dealing with? And some of the agencies even now have ESG criteria where they won't facilitate an inbound investment from a company that is not ESG sound. So it's quite interesting space right now. Again, all where the trends that you see in broader investment fit with the trends that we're seeing in corporate FDI. So.
And I think it's interesting to see how some of those trends will be driving what we'll be reacting to in the real estate industry as well. Does anybody have any questions or thoughts they want to contribute?
Thanks. Yeah, I want to come back a little bit more to the cyclical aspect. I mean, I agree with all the structural changes happening in ESG. And it's more short term, because I wonder, you see the price corrections and you see that reflected in the yield data. But I'm just asking myself, where's the product coming from? Because, you might think, well, at these prices, it's great to get into the market and fill your boots and access some of these assets at pricing you haven't seen in the last 5 to 10 years. But yeah, there will be a few funds which have redemptions. Maybe there's the odd investor who looks at refinancing and goes like, what, it's not worth it, let's just sell it. But where on large is the product coming from for investors that sit on the sideline with equity to get into the market now?
And I think you'll see assets trading where markets have moved the fastest So without wanting to describe the UK as a volatile market, the transparency, the markets that are more transparent, I think, are going to trade first.
Sure, but who's selling? Why would you sell the asset if you sit on it?
Well, I agree. I mean, so in the US, our US side talk about distress in the markets and lots of distress, and all this distress is going to happen. But actually, when you come down to it, we're entering this kind of mini recession with fairly low loan-to-value ratios, pretty robust balance sheets. Occupier markets are fine. So yeah. So why would you? Why don't you wait it out? I agree.
Yeah, I agree. There's not going to be a bonanza of you can buy all that sort of stuff really cheaply. But there's things going to come to the market, and it's driven by lending, I think, because all-in costs in the Eurozone like 5% towards 6% in the UK. Even with good assets, your rent often doesn't really cover that or barely covers it, and that will drive people to the market. They're not going to sell it. There's no reason to sell it rock bottom, but they will have to get. There will be people who have and want to get out, and the liquidity so far has been quite good, and also because that the driver is everyone is hit by this, so there's no discussion about should the price have changed. So that makes the market. I mean, UK moves much faster than everywhere else, but even the rest of Europe, there's more movement than we have seen after the GFC, where people were clinging on to their values for dear life. So it's a bit more active now. But yeah.
If come back to why would I sell an asset? I mean, one of the aspects we heard indirectly in your presentation, spreads are in the corporate world are widening. Other asset classes are getting more interesting, and that's, I guess, an environment where some of the capital can flow from the real estate into other asset classes because it's just more interesting. So. There's the various motivations for that.
And there the US is more the leader. They get more redemptions. So in Europe, people are holding on to their investments. But in the US, they very quickly see people are moving out. There's something interesting there. And then they sell, and they say, well, I still made a profit. It would have been higher if I sold a year ago, but I still make a profit. So, and then move into corporate bonds and get 7%.
And we did actually see a couple of, I think it was last week or the week before, we mentioned it on Realcast, a couple of regional shopping centres trading that I don't think would have traded a year ago, for example. Now, I don't know why that was, but it's just interesting to see some movement there. I want to make sure we've got time for networking and coffee afterwards, which means everybody's got 30 seconds to answer this so that we can be there in 2 minutes, which is, so biggest challenge, biggest opportunity for 2023?
Well, one of the biggest challenges will be next to the horde of black swans that we've talked about, inflation, interest rates, ESG, and so forth, will be to assess how the city of tomorrow will be like. I mean, we haven't touched on the subject of multipurpose. So the ideal investment which we would like to finance would be diversified, tenancy schedule, transformable usability, flexibility in each possible way, and of course, deep pockets.
Deep pockets. Thank you. So, biggest challenge, I think, is to wait for the transaction process, to Ollie's point, to wait for the transaction process to come back to life. So that I do see that as a challenge. I think the biggest opportunity has to be around data. Oh, there we go. Sorry, mate. So it has to be around the aggregation and use of data, bit of AI. Anybody wants to throw AI into that, on mapping, that has to be the biggest opportunity for us in the world of real estate.
Audrey, you are allowed to agree on your biggest opportunities.
I agree, Megan,
Thank
with
you.
everything you said. No, from an ESG perspective, the biggest challenge is the collection of data. Yeah. So that problem has not been solved. There's a lot of software to help you with that, but there's not a one-size-fits-all. So as far as the opportunity goes, life science, data centers, anything resi.
Just to go into something different, I think it is the challenge and opportunity at the same time is around the residential sector in Europe, because at the same time you have very strong growth and rental growth, but there's so much regulation coming in making it almost impossible to capture that. So anyone who can find the right balance there, I think, has a challenging investment, but probably quite rewarding if you get it right.
Yeah.
Affordable housing in the UK is a big opportunity.
Okay, good. If you could join me in thanking yourselves for being here and the speakers, that would be great. Thank you, everybody.